Hi, for those of you that this is the first time you're watching this presentation, my name is Mike Bradley, and I'm a wealth manager out in San Francisco. I use these blogs as a way to talk about some subject matter that I think might be of interest to clients and friends and colleagues. Today what I want to chat a little bit about is there's been recently getting some press attention to a subject matter which it continues to surprise me that this continues to be a problem, and that is what's called stock options backdating. Now, most of my viewers are going to understand this concept, but I think we'll review it briefly, is that stock options or employee stock options are when a company issues the right to purchase a company's stock at today's price to its employees and executives. And this is a way of trying to align the interests of the shareholders with those of the executives and employees of the company, meaning that if the stock price goes up and the shareholders make money, that the appreciation of the stock price will also mean that the executives and the employees of the company will make money. And I think that this is ordinarily an excellent practice. I think that it's extraordinarily fair, and I think that it probably really will have the effect in most companies of encouraging people to be focused primarily on increasing value for a company. But in the case of certain companies, and this was a number of companies got mired in scandal a few years ago over this issue, what they have instead done is found a way of paying their senior executives even more money by looking back at the previous 6 months or 3 months or a year or whatever, and looking at points in the stock price where it is at its absolute lowest, and then issuing stock options to their executives at those prices rather than today's price. And so that's what you mean when you say stock option backdating, is the process of creating essentially an artificially low price to enhance the compensation that an executive receives. And there are reasons why you might give an executive stock at a lower price than it currently trades at today. I mean, there are certainly plenty of reasons for why you would do that, but that really isn't truly a stock option, and there are accounting methods for dealing with what you call a discounted stock option. And that's not what's happened in the case of these companies, which have engaged in stock option backdating. Now, as I said, this came up a number of years ago, and we kind of thought that this issue had been dealt with, and that it wasn't terribly widespread to begin with. It was seen as kind of one of the excesses of the dot-com era. But recently, there's been a lot of press given to a new study by Professors Whisenant and Eldelson at the University of Houston. Always leave it to a less regarded university to provide the most interesting research on subjects like this. And that's not always true, but it's surprising how much of the best research, in my opinion, comes from these kinds of sources. But what they have identified is that there's probably around 500 of the 3,000 or so major publicly traded companies where there's evidence that stock option backdating went on. And in 141 cases, it's pretty much impossible that these options were issued anything other than ex post facto, that there was anything other than backdating. And in finance, there are a number of areas that are morally ambiguous, particularly accounting. It's hard to tell the difference between accounting that's aggressive and accounting that is misleading. The tax code and a number of other things create legitimate reasons for why people would present information in a certain way, and there are certainly reasons why you might issue discounted stock options to an executive. But when you conceal that from the shareholders, and pretty much what you're doing with stock option backdating is you are transferring wealth from the shareholders to the executives in a way that is not honest. And so really this is an outright theft of the shareholders' wealth by the executives and abuse of the system. And so one has to ask themselves, well, why is this going on? And this is going on because the boards of directors of these companies are composed increasingly just in all companies. The boards of directors are composed of people who don't have a particularly large percentage of their net worth invested in the equity of that company, and so their financial motivations aren't as strong as they might have been in previous years. And because shareholders don't really hold boards accountable for poor decisions because of the low cost of selling a stock. Back in the 1960s when you had fixed commissions, people held on to stocks for decades. I think the average holding period was well over a decade in the 60s. And today, the average holding period for a stock is less than a year. And so this basically, propagates an attitude that people have where they don't really think that it matters. And so if a company isn't run well, the stock price won't do well. And so if the stock price doesn't do well, they'll sell the stock. And so their view on these matters is that it's not their responsibility. And so you have a sort of tragedy of the commons problem where everyone kind of assumes that this is someone else's responsibility to handle keeping the executives in line and basically preventing them from stealing from the company. And I think that, the same as voting, your individual vote doesn't make a huge difference in a political process. Your individual proxy vote doesn't make a huge difference in the proxy process. But by voting, you create an accountability for the executives of these companies. You let the boards of directors know that you are asserting yourself. And I think that this is the primary method of being able to prevent this from happening in the future, is to vote in proxies. So we here at Bradley and Company are looking at our current policy, which is not to vote proxies for clients, and evaluating as to whether or not that's something we think we should be doing in their interests, and then also in the interests of kind of society as a whole. But also, we're actively encouraging our clients to look at voting their own proxies rather than just kind of tossing those piles of mail that you receive into the garbage, which I know is all too tempting to do. So please give us a call to discuss this issue if you want to review it. If you are not a client, I would just say, consider whether or not you want to vote in your next proxy. And if you are kind of outraged by this practice of watching so many companies that have clearly misused their investors' money and basically stolen from them, I think that it's not out of line for you to send an email to your representatives in the Senate and the House of Representatives, to the Attorney General of your state, and to the District Attorney of your municipality, expressing your displeasure at this practice. It is clearly something that the market has not resolved on its own. So I'm hoping that shareholders will assert themselves, but I'm increasingly coming to the opinion that actually some efforts need to be put into place to force boards to do their function, which is to act as fiduciaries of investor capital. So thanks a lot for your time, and thanks for listening.